Hi, this is the last video that was going to talk about some things from today on Friday, um, but snow day obviously. So this is going to talk about the yield curve. So two terms, term structure and yield curve. The term structure talks about the relationship between the time to maturity and yields. Everything else is sort of ignored, so nothing to do with risk, coupons, anything else, okay? Just the relationship. The yield curve is basically a picture, a graph showing the relationship between yields and time. So, normally a straight, some type of line, straight line, curve, whatever you want to talk about. So normal, upward sloping. Long-term rates greater than short-term rates, so it would be upward sloping. The opposite is an inverted yield curve where short-term rates are actually greater than long-term rates. We can talk about that in class, why we think that might be. Okay, so the yield curve. I'll show you a very simplistic view of a normal upward sloping yield curve. On this, remember the nominal rate, 1 plus r equals 1 plus the real rate plus 1 plus h, where h is inflation and the real rate is r. You can ignore this risk premium for now. We'll talk about that later. We'll actually talk about that probably more in future chapters. So an inverted yield curve, what's that look like? Downward sloping, where you can see future rates are lower than current rates. So why do you think that would be? Think about that. We'll talk about that in class. In an inverted yield curve is inflation and the interest rate premium. Are those really the only things that would go down over time, or could the real rate essentially go down over time? So think through that and think through situations where that might be. Okay, so we'll talk about government bonds now, right? Treasury securities are federal government debt, different types. Treasury bills, we talked about this in class, T-bills as they're known, right? So these are pure discount bonds, no coupons, very short term, generally 3-month, 6, 9-month, and a year. Okay, so T-bills are very important security in investments. Think about why that is. A lot of it has to do with being discount and less than a year, right? So it's pure time value of money. Because there is no coupon, all you're looking at is just how much return do I get for giving you money over a period of time. There's no coupons, nothing else involved. Also, this is what's known as the risk-free rate of return. So a T-bill is often referred to as the risk-free rate because the government will not default on its debt, and it's basically does not have any coupon rate, it doesn't have any risk, any prepayment, it doesn't have any of the other types of risks that we talked about a week ago. Okay, we'll talk about that later. Treasury notes, T-notes, they pay a coupon, so unlike T-bills, they do have coupons, and they're medium-term maturity. So between 1 and 10 years, we'll see that the two most important ones to talk about are T-notes that are maturing 2 years from now and 10 years from now. Those are what we look at when we talk about the yield curve for the United States government. And that generally we'll talk about, we'll look at a view on the future of the economy. So where we think the economy's heading and sort of mid-term, not real long-term. Next thing are T-bonds, treasury bonds, also coupons, and these are much larger maturity, past 10 years. Most common one being 30 years, okay? And that one is sometimes called the long bond. And why is it a very important bond, the 30-year bond? Because 30 years is sort of looked at as sort of long-term capital investment for corporations, investing in a factory, investing in new plants and equipment. For people, home mortgages generally are 30 years. And so by looking at the 30-year government bond against those, you can see what the difference in rates are as far as default rate, risk premium, other types of things when you're comparing like maturities. So let's look at the U.S. Yield curve. Okay, this is again looking at the difference in yield between a 2-year and a 10-year Treasury note. and it gives you that sense of the economic outlook for the future. Okay, this is what the yield curve looks like in February, a couple of weeks ago. So you'll note 2 years and 10 years. And what do you notice? It's very flat. Not much of a difference between a 2-year and a 10-year. Think about what that might be and why there wouldn't be much of a premium for giving your money for 10 years versus giving it for 2 years, and what type of behaviors in the market that might cause. So now let's do an analysis, okay? So February of 2019, which is what we just looked at, February of 2018, which is the red line, and February of 2017. So what do you notice? Well, from 2017, 2018 to 2019, the slope between 2 and 10 years has flattened quite a bit, right? Why do you think the slope might have flattened between the last 2 years, where there used to be, if you look at this, 1.5 to, I don't know, 2.25. Bigger difference premium between 2 and 10 years that you see now. Think about what might be going on and why that would happen. Now let's look at 2 other yield curves. February of 2019, right? So we've looked at this one in a couple pages, and February of 2007. And you'll notice this one actually sort of slopes down a little bit, but fairly flat. Right? So what was going on in 2007 in the economy? Think about that, okay? Which might have caused some of this. What happened in 2008 that maybe this curve in 2007 was giving you a hint about? And why do you think the yield curve now is similar to the yield curve in 2007? The economy is in a much different place than it was then, so why would the curves be similar? Think about that, right? And we'll discuss that. Now, take a historical view, last 45 years. You'll notice it bounces around a lot. You guys don't remember anything probably prior to around here, but if you'll notice in gray, these were recessions, U.S. economy recessions. And you'll notice what's happened. Every time that yield curve pops below 0, which means it's an inverted yield curve where long-term rates are lower than short-term rates, something happened, right? It's actually predicted every recession the last time, every time it's happened. So here's where we are now. Something to watch, something to look out for. Make sure we understand what's going on. You'll notice the Fed had recently, in the fall, had been starting to increase interest rates. Part of it to offset some of this, part of it to slow down the economy a little because they felt it was overheating. But here's something to watch and a reason to keep an eye on the yield curve, because if it dips below that line, we might see a slowdown. So that's a way we use things like the yield curve to help predict what's going on in the future.